Okay, thank you very much, gentlemen. We're right on track to start the final part of the day, and I've tried to talk her into visiting Frankfurt so many times, and at least it works virtually now. So welcome, Jessica. It's great to have you with us. Go ahead, the floor is yours. Great to have you. Looking forward to your presentation.
Okay, great. So again, thank you very much for inviting this paper, which is joint with Mehran, Ebrahimian, and it's great to be here. Okay, so like the similar talk, so we were very interested in what seemed to be a disconnect in asset pricing between the vast literature in corporate finance that not only suggests, but in some sense insists on a role for liquidity, intermediation, financing frictions, et cetera. On the other hand, in traditional asset pricing, there's just a stochastic discount factor and cash flows, and the stochastic discount factor is guaranteed by the absence of arbitrage. Now, you can always put whatever you want in the stochastic discount factor, potentially, but we were interested in the kind of frictions that would generate that basically couldn't be gotten beyond between sort of, I guess, technological innovations. And so in the interest of time, I'm just going to go briefly through what is a potentially vast related literature. So as I said, we were interested in how the intermediaries could become so important in our work. What the mapping is, as in a large literature, there are financial intermediaries who have special technologies. In our work, there are individuals who can potentially gain access to human capital. And then they are subject to a moral hazard constraint. So that's the similarity. And quantitatively, what gives us a little bit of an extra kick is non-convexities in this human capital formation. So there's a literature on that. And we also endogenously generate counter-cyclical labor income risk. Now, my co-author is very interested in development, and there's a sort of parallel literature in development about how one could be stuck in a poverty trap. And then, of course, I'm interested in rare events, and this is a way of generating from normally distributed risk, fat-tailed risk. Okay, so I'm going to just jump into the model. Okay, so basically, there are the following production opportunities. So individuals can work in the traditional sector, in which case they earn H0. They can invest some fixed amount to acquire human capital and then potentially earn delta H. The point is delta is a random variable. If the individual puts forth effort, the human capital investment earns delta H, otherwise 0, and there's a private benefit. And then there's inventory. So all investors can put funds into inventory with net return 0. And there's also a contingent claims market on delta. Okay, so one thing that differentiates us from the standard Holmstrom and Tirole setup, of which is very similar, in which there are many papers, is that we have risk-averse individuals and we have and investors. So both the individuals who are subject to moral hazard and the investors who are funding them are risk-averse with log utility, identical preferences. One is not more patient than the other, and there's aggregate risk. Okay, so it is a 2-period model at the present time. There's complete markets, except for whatever is generated by this Holmstrom and Tirole type moral hazard problem, where the individual can choose not to put forth effort. So there's T equals 0 trade in the arrow securities, the T equals 1, the state of the world is realized, and the individual makes this 0-1 occupational choice. At T equals 2, there's this effort choice, which is non-contractable, and the security payment settled. Now, the fact that the individual might not put forth effort, that's an off equilibrium threat. That doesn't wind up happening. Okay, so as I mentioned before, the individual's production opportunity set is non-convex. The agent is either fully invested in human capital or in the traditional sector. Investment in human capital is always first best. That makes it interesting, but also it's different from other setups which don't have that feature. And as I mentioned before, all investors have identical log utility and patience. Okay, so there are outside investors. They trade in competitive markets. So they fund the individuals, but at the end of the day, because there are so many of these outside investors, they don't earn any abnormal returns. So we can view their problem as a completely standard one. So they maximize utility subject to the standard budget constraint. This pi delta is, of course, the state price density. Now, the state price density is not going to be what it will be in the standard frictionless economy. More interesting are these individuals. So we're calling them individuals as opposed to the standard entrepreneurs, because entrepreneur is, it's French for people who move capital from one to another. Here we're insisting on this human capital interpretation, and it's non-convex. Okay, so there's an occupational choice. As I mentioned, it's non-convex. And so the individuals solve, again, expected utility. So here is their budget constraint. Okay, so their budget constraint is, so they can consume, but they also need to fund their investment. And then they have their endowment E. Okay, what do they have in the next period? Well, if they work, they get the returns from their human capital. If they don't work, they are in the traditional sector and they get their investment back, and then they consume. So this is their budget constraint. Now, this budget constraint is only valid if it's incentive compatible. So they're only working if if they won't shirk, and they can't commit to not shirk. So period 2 consumption must be greater than alpha F. So in equilibrium, the individual always puts forth effort. That's implicit in this problem. But note that this is now an incomplete market, right? Because this individual cannot trade claims on this future budget constraint. I mean, on the future human capital. It cannot trade whatever contingent claims he or she wants, and it's because this individual cannot commit to put forth effort. Now, if this individual is wealthy enough, this does not actually become a problem. So we're going to have two types of individuals: those who are wealthy or those who are not. Okay, but actually, the qualitative features of the model don't depend on that. You could have all. If everybody's wealthy enough, then you get the frictionless first best. If nobody is, then you get kind of a more dramatic version of our answers. Okay, so there's multiple interpretations of that budget constraint. One is as a optimal contracting problem. One is as a human capital interpretation. So here's a human capital interpretation. So on the left-hand side is the individual's value of their consumption bundle, and on the right-hand side is their possible resources, which include their endowment and what they can make or not make. And the point is that there's this endogenous market incompleteness. I already went through the full flow of funds interpretation. Another way of seeing this is it's the outside investors' participation constraint. Okay. So just to review, if there's no frictions, then we get kind of the standard solution. So optimal consumption for everybody, this lambda J is going to be their Lagrange multiplier on their particular budget constraint. So everybody's consumption is just the inverse of the state price density. And for the investors, that's just the Lagrange multiplier is just their endowment, 1 over their endowment. For individuals, it's their effective endowment because they're all working. Okay, now That's the frictionless economy. So you could nest that in our case with alpha equals 0. In the economy without frictions, what happens? Okay, so so investors are in the economy with friction. Sorry, what happens? All right, so the investors, it obeys the standard form. The question is, what is this pi delta? For individuals, it's a little different. Okay, so if they are not working, then they consume at this unconstrained amount. If they are working in the human capital sector, then they have to be compensated. So it's the max of their unconstrained amount in alpha F. And so this introduces some interesting features, and in particular in equilibrium, it's actually going to introduce 4 different regions. Okay, so just to review the features, if the individual works in the traditional sector, there is it's sort of locally like the frictionless economy. So C2 star is just the optimal consumption plan in the absence of incentive compatibility. If the individual invests in human capital, if unconstrained consumption is sufficiently high, then everything's fine. If the unconstrained consumption were to violate incentive compatibility, then the individual consumes alpha F. And then there's a trade-off that this individual faces between, in terms of, if this is high enough, we're fine, we're always working in the human capital sector. If this is not fine, then whether or not to work is basically, whether or not working is the optimal policy is really a question of how expensive is it to eat alpha F rather than the optimal C2 delta star. Okay, so this is a proof of that, which in the nature, for time, I'm going to skip. What is equilibrium in this setup? It's a state price density and allocation. Given prices, allocations maximize the optimization problems, markets clear, inventory, as an additional wrinkle here, there's an inventory. So actually there's a 0 lower bound in this economy. I'm going to skip the frictionless benchmark and go on to the case with friction. So as I mentioned, we get this interesting 4-region case. So hopefully I'm going to be able to show okay, we're going to have to skip to the other PDF file that I have here that's going to show that where my graphs actually came out for whatever reason. Oh, I remember why. Okay. All right. So let me tell you about the equilibrium. How much time do I have?
You have 13 minutes left.
Okay, fantastic. Okay. So equilibrium. Okay, so there are 4 regions. So fix for a moment this level of inventory and fix the Lagrange multiplier. So in the lowest possible region, none of the investors who have the lower amount. So there's a so the state price density. Actually, this is the typical form of the state price density. It's just 1 over kind of the resources available. There's a middle region where some of the constrained investors are working, and pi is some complicated feature. Then there's another region where they're all working, but pi is still constrained, and then there's finally this unconstrained region. Okay, so I'm going to go on and tell you about what we get out of this, and then I'm going to show you some figures. Okay, so here's the optimal policy for the agents who can't afford to finance themselves. So here's the endowment. It goes from this is a cumulative density function. It goes from not so good. This is obviously the best. Okay, so here we see the frictionless case. The individual is always investing in human capital. Here we see a case where there's frictions, but it's a convex technology. So I'm mainly going to talk about the convex technology case. So here there's this individual is not investing. Here some proportion of the individuals are investing, and here all the individuals are investing. But just because all the individuals are investing here does not mean that it's first best. Okay, so here's the state price density. So what we see from the state price density, this is the state price density with no friction. So of course, this is log utility. The state price density is lower in good states of the world and higher in bad states of the world. So what happens in our case? Okay, so one feature here is that the state price density is always higher. That's basically because there's fewer resources, there's more precautionary savings. That's going to push down the risk-free rate, which is what we want. That's realistic. It's also more volatile. So you can see that it's higher here and lower here. But then in the worst regions, the state price density actually falls and becomes like the frictionless case. And what's going on there is it's exactly corresponding to these regions here, where the individuals are not employed and the investors claw back their money. So here we have aggregate consumption, and it looks, so again, this is the frictionless aggregate consumption, increasing in the state price density. It looks like it's not so bad, but it's going to reveal some interesting dynamics, but it is different. So this moral hazard problem does create what I refer to as rare disasters, in that here are regions where, I apologize for that, there are regions here where normally not much is happening, but the consumption is actually much worse in the case with frictions. And what's causing that is exactly the fact that these individuals cannot be incentivized to work. Okay, so I want to show you a few more graphs before pointing to the numbers. So we're going to generate an equity premium in this economy. And the reason for that equity premium is going to come from the fact that the individuals need to be compensated in order to work. And that keeps their consumption very high for most of the state space. So this is for the individual who needs outside financing in order to take human capital. So here, this individual normally would be consuming much less in the frictionless case, is consuming a lot, relatively speaking. Outside investors, you can see, are getting much less of the dividends they would be getting otherwise. So this gives you basically pro-cyclical dividends, which is realistic. However, in the very worst states, it's no longer worthwhile for this to compensate this individual to work. Consumption is extremely low. This is a true disaster for this individual, but the investors actually claw back their fixed investment. And this is what generates counter-cyclical labor income risk for these individuals. So returning to the equity premium, okay, so here, imagine that there are headers here, where one of these, this last one is the frictionless economy, differentiated by the fact that it's got a high risk-free rate of 5%, and it's got an equity premium of basically 1%. So in this calibration, our equity premium doubles to 2%, even with log utility. Now, why is that? Well, part of it is just because of a risk-sharing argument. It's because the state price density is more volatile. And you can see that because the equity premium is still notably higher. By the way, this middle column is the convex case. So here, the dividend claim, basically the consumption claim is higher. So yes, so it's not just because of the fact that dividends are more pro-cyclical, but it is in part because of that too. And you do get a lower risk-free rate because basically there's this added distortion where all agents are trying to sort of save their way out of this problem. Okay, so there's a couple of interesting distributional consequences here, which is that this friction, so these agents would very much like to tie their hands. So by the way, so I showed you the case where, say, half of the individuals are constrained. If all of them are constrained, you actually get essentially like double the effect to about 4%. Okay, so here you have individuals who are constrained, the L, the H are the individuals who are unconstrained but still have human capital, and the I are the outside investors. And you basically get a divergence of what's happening between, if you compare the non-convex case with the frictionless case. Okay, so for the worst off investors, individuals, utility going from frictionless to non-convex it's not a good thing, right? You definitely get a loss of utility, but for the high type, you actually don't get any cost at all. This is because of log utility. For investors, you actually interestingly get some cost. For the value of their human capital, the investors actually do better. The individuals who can actually invest do better than those who cannot. And in terms of the marginal utility of wealth, you can really see a deviation here, where the marginal utility of wealth in the non-convex case for the low cash on hand individuals is extremely high. So what is the reason for all of these patterns? Well, actually, so when there's frictions.
5 to go, Jessica.
Sorry?
5.
Okay. When there's frictions, the value of human capital goes up because the interest rate falls. But for the L individuals, for the individuals who can't finance themselves, this actually is countered by the fact that they actually can't run their operation in the worst states of the world. But for the H individuals, it's only a benefit. So in terms of their utility, that's why the H individuals aren't worse off at all, whereas the L individuals are. Okay, so so to conclude, so we introduce a model with inalienable human capital, and the purpose of this was to see how, what this would work in an otherwise standard asset pricing model. So one thing that it can do, and in fact, our original motivation was to have it explain deep downturns because individuals cannot meet incentive compatibility constraints in some states of the world. So in some states of the world, it's no longer worth it to incentivize individuals to work. But certain other implications turned out to be more important in terms of generating an equity premium. Interestingly, this implication in some sense hurts us in generating an equity premium, unless we consider an implication unless we consider a calibration where this becomes like ever increasingly unlikely. Okay, so what generates the equity premium is that even during normal times, risk is inefficiently shared. Basically, individuals take on too little risk because they need to meet the incentive compatibility constraints in bad times. What's more, again, because not only is the state price density distorted, the dividends that are paid out are pro-cyclical. They're too risky. Moreover, because the fear of bad times, basically an attempt to save one's way out of this, the interest rate is lower than in the frictionless economy. And as I mentioned, the suboptimal risk sharing and actually rare disasters, particularly in the case where parameters are such that they are expected but they don't appear, imply that the equity premium is higher. So I apologize for the quick technical switches, and I am looking forward to your comments, and thanks again.
Thank you very much, Jessica. The discussant is Miguel Palacios with an impressive picture in the back. I actually was expecting to see probably a polar bear there, or right from Calgary. It's great to have you with us, Miguel. Haven't seen you in a long time. Looking forward to your discussion.
Thank you, Christian. Thanks for the invitation to discuss this wonderful paper. First of all, what a wonderful paper to read. Jessica, in her presentation, tried to pack in 25 minutes lots and lots of very well described intuition that makes it fantastic. It's a fantastic read and highly recommended, in particular for, say, PhD students in the audience. This paper transmits the intuition of everything that is important in asset pricing, I think, in a very clear, didactic way. So thank you, Jessica, for that. And I have to say that try to putting it 25 minutes is tough. So my first recommendation is go for the paper because there's lots of subtle details that show up there in a very clear way. Now, I'm going to focus my discussion. I mean, first, I'm going to talk about human capital and asset pricing, provide the key intuition for the model, which Jessica already did, and then I just have two comments, two relatively big comments, meaning wide-ranging rather than, let's say, rather than killer comments. Now, as I was hearing Jessica speak, she was emphasizing that they're focusing the model on individuals and it's about human capital, and that they want to get away from the entrepreneur. In my discussion, I'm going to be talking about the entrepreneur. And in fact, one of my comments is going to be about, how can we interpret this in individuals, or should we be more generally thinking about entrepreneurs? So sorry, Jessica, if I'm taking you away from the interpretation you want. Okay, so here we go. So why should we care about human capital and asset pricing? Well, human capital, it's has the largest dividend flow in the economy, so that should matter, and appears to induce leverage, right? So it not only is this big flow, which presumably affects things like prices of risk, but also induces leverage, which induces a difference, say, in the equity premium with, say, just the expected return of aggregate consumption. Now, the issue is that it's challenging to deal with human capital. We don't observe its returns, and control is non-transferable. So it's been a challenge to deal with it. There's a long literature dating back from the 70s that's dealt with human capital. And though that literature is growing, I think the contribution is still an open book. And this paper is an example on how to continue on that book. So what's the paper's contribution? First, a very tractable G model, which we can, so for those of us in the audience who have done production asset pricing models, that not all of them are tractable. This one is very tractable. And it's tractable even though it is incorporating this feature of non-transferability of human capital. So most of the models out there that have human capital in macro asset pricing, so wages are going to be the marginal product of labor. Maybe they're going to be sticky, but there's not the essential part of what makes human capital complicated, which is the non-transferability. The absence of slavery is not there. So this paper does it, which I find fantastic. Now, once you do those two things, you get helpful implications for asset pricing. And I'm putting helpful in quotations because I don't think we're there completely, right? So we need to talk about how far we get. And finally, we get some sort of pricing implications for wealth distribution, which Jessica was trying to discuss or was discussing at the end. So there's much to like in the paper. So here's the key idea, and I start from a quote that I hope is in the current version, because I also saw, as Jessica was presenting, that she's working, basically the paper is evolving. We take as given individuals cannot sell claims to their human capital. This has been said many times in the literature. The following sentence doesn't show up always. However, individuals can pledge some of the resultant cash flows. And that's important because it means, at least it helps us advance on how to model this non-transferability of human capital in say, in a macro setting, where basically we should be able to look at cash flows that are pledged because those are enforceable, but you can write contracts in which someone agrees to pay a fraction of the wages. That's okay. What is not okay is a contract in which they commit to do something. And so this sentence is capturing that idea. And that's what they're putting in. Now, once you incorporate that idea, then you get something interesting, which is that individuals what individuals can pledge is state dependent. So in bad times, effort leads to lower payouts, so shirking is more appealing. And so it's going to be more binding to try to compensate someone to make sure that they work in bad times. In good times, there's large payouts, so shirking is not a problem. That is, in good times, everyone is going to do the first best optimal. It is when times get bad, maybe I see that if with my effort I'm going to get less done, so all of a sudden being lazy becomes less of an opportunity cost. So the consequence of this is that we need to bribe owners of capital, and so owners of human capital, to produce in bad states. And that's this, the equation that Jessica showed. It's basically, we need to ensure that the consumption of these owners of capital is large enough. Because if it's not large enough, then they'll choose to do nothing. And what that means is that in bad states become worse for the rest of us. And when I say the rest of us, it's investors who are trying to get these owners of capital to do something. In bad times, times were already bad, and now I have to pay these people a bribe to continue working, so things get worse. And that captures the intuition of what works in the model. Okay, so that's the key idea. Here are the key ingredients. So here's the timeline. It's very similar to what Jessica showed. I'm relabeling a couple of things that I find easier to interpret the model. Right? But I think Jessica is not going to like it because it takes us away from, it's the individual making the investment in human capital, and it takes us to the idea of the entrepreneur. So here's what's going on. So 2 periods. On the first period, there's some consumption. So let's think of it in terms of a rice economy. We start with some rice that it's on silos. That rice came from previous history that we don't care about. And we're choosing how much of the rice to consume now and how much of the rice to consume later. And then there's some uncertainty revealed. This uncertainty is the weather. It's going to be whether putting rice to grow is going to deliver a lot of rice, or if it's going to deliver poor rice, so little rice. So it's, let's think of humid season when the yields for producing rice are going to be high, or dry season when the yields are going to be low. Now, the capital owner in this rice economy is the owner of a plot of land. And this capital owner is going to decide whether to use some rice to put it in their plot of land to produce more rice in the future, or whether they just are going to take whatever is in the plot of land, which is much less productive, and use that. Okay, so in the paper Technology A, which is use rice to produce more rice in the future, is what Jessica would call an investment in human capital. And then you do nothing, don't put extra rice in your rice paddy, just let it as it is, would be continuing with your current occupation in their model. Okay, once the choice of technology A or technology B has taken, that is in investment in human capital or no, has taken place, then this investment is ready, and we go to the second period, when the capital owner again decides whether to exert effort or no effort. And so no effort means they don't go and take the rice out. They maybe just walk out their door and get a little bit of the rice for themselves. And if they do effort, they actually go and take all of the rice from the rice paddy out. And so at that point, claims are paid, consumption takes place. And in their paper, everyone dies. In here, everyone lives happily ever after. Okay, so that's the model. Now, why do they need these the 2 technologies and the effort or no effort? So here's what these things buy you. So the production choice, that is the investment in human capital or not, or if it's a rice economy, the decision to make your land much more productive or not, delivers endogenous possibility of disasters. That is because if for some reason all of these capital owners decide that they're not going to invest, then the amount available for consumption later is going to be much smaller. Okay, so that the choice between these 2 technologies or investing in human capital or not is what allows for the possibility of disasters. And so you can think of this as an Ayn Randian economy, right? In which if these people who drive the world decide to step out and don't do the things that drive the world, then consumption is going to be much smaller later. So that's what you get from production choice. Then from the non-transferability of human capital, which is the fact that you cannot write a contract that forces people to not shirk, what you have to do this bribe, and that this bribe means that the payments to human capital are going to be too high in bad states of the world. And so this has two consequences. That means there's imperfect risk sharing. That is, without the friction, the human capital owners would be willing to sacrifice some consumption in the low states, but they cannot do that given the friction. And as a result of this, equity suffers from a labor leverage, because we, the equity holders who would finance the investment in human capital, we're going to have to make these high payments to the human capital owner. Okay, so those are the key ingredients, and those deliver the model's intuition. You can see it. I'm going to show two graphs that Jessica showed. The first one is state prices. And so Jessica went through this. I'm going to just mention it very quickly. And this is part of what the paper does very good. It contrasts this black line, which is what happens when there's no frictions at all. So the black line you should think of as your standard Lucas economy with log utility. Okay, so it's that's what you get. And then once you introduce this friction, what happens is that basically consuming for consumption for different states in the future becomes uniformly more expensive. That means the risk-free rate goes down, and the curve becomes steeper. That's because the problem of the friction is worse in bad states of the world. That's why it's steeper. Now, Jessica did point out, if you look at the red dotted line, that's when you have this, the non-convex technology, which means that you either make the investment or don't make the investment. At some point, things become good, okay, and this is the point at which there's a disaster, because the owners of human capital decided not to invest. Now, once you take the disaster into account, the risk sharing becomes okay. And so that's what the very last corner here gives you. That actually goes against the model in the sense that once the disaster has happened, the risk sharing is working. However, the distortion throughout all of the state space, it's still there, right? And so it's higher, so lower risk rate, and steeper, which is a higher risk premium. So that's state prices. And then the second graph that captures the intuition clearly is, all of the graphs capture the intuition clearly. This is the one that helps me most. Is this one here on the left that shows the dividends paid to equity as a function of the state. And so the thing to focus is that the black line is what the dividends would be to a normal equity share without the friction. The green line is what the dividends, the equity claim under friction receives, and it has this shape because it's worse in bad states of the world because we're having to bribe these the human capital owners, and so this bribe is costing us. That's where it's showing up. Now we're willing to pay that bribe in exchange of paying less in good states of the world, and that's why in the very high states of the world, the dividend that we get as equity holders is high.
That's 5.
Okay, so that summarizes the model. There's many more interesting features of it, as Jessica showed through her presentation. What I'm focusing here is on the basic intuition. Okay, so now my 2 cents. Is the paper really about human capital, right? So this is Jessica saying, hey, I want to do we want to focus on the interpretation that this is individuals. And when I was thinking about this interpretation, I was thinking, so what is the investment in human capital that would show up like this in the economy? Should it be education? And they motivate education as one of the investments in human capital. But I couldn't figure out how to take, realistically speaking, say investments in education as what the model is talking about, right? We don't see claims, or we don't think that's the big problem, and it's definitely not a big problem when we measure things like the equity premium, which is all based on large companies where presumably people already have most of their education human capital. So it seems to me that the model is really about control. And one of the features of human capital is the possibility of transferring control. But this is also true in many corporate settings, right? So when I think of my proud ownership of Chipotle shares, right? I am a minority shareholder in Chipotle. I have no control absolutely over Chipotle. So I am like the investors in this model. I have no control of what Chipotle does. In particular, I would like them to come to Calgary, but they don't. So that's affecting my consumption. I don't know if that's a story about human capital. It's definitely a story about the fact that I don't control Chipotle and someone else controls Chipotle. And so I'm not sure that pushing the model as it's individuals doing their human capital is going, maybe it's, I think there's instances where it definitely matters for individuals with their human capital investment, but I don't think it's going to help us that much to tie it to macro asset pricing models. I think the idea of corporate control and the issues with someone has control of corporations and they might be not doing the investments that we want them to do might be easier to tie to macro finance. So that's my first comment. So I think the control problem is a bigger one than the control problem only in human capital. My second comment, which goes in line with what I just said, is that it's unclear how or whether the model should be pushed quantitatively very aggressively. And by that, I mean, say, making the equity premium matching as part of the abstract, perhaps. And the reason I say that is, it's again, first, because I'm not sure how we tie this model to the data. And I don't know how we do an appropriate calibration of the model. So asset prices in this model depend heavily on endowments, on the commitment constraints. I don't know how we're going to get those, how we're going to take those variables to make it fit here. And I don't see it clearly. And if that's the direction that the authors want to take, I think the paper needs much more explanation of where is it that we're going to come with what we observe empirically to tie it to things like the equity premium. And I mean, so the numbers that Jessica showed are a little bit different. So they've been working on the model, but they're not qualitatively very different from what I have here. I say, look, the equity premium looks much better than the frictionless case. That's the intuition is clear, and that's great. But if we look at these numbers, I mean, we see, if I interpret this correctly, volatility of consumption of 12%, which is, let's say, way off what we would have in a macro asset pricing model. I don't know how to take what we see in the model to say, let's say, help with that moment. And so I'm thinking maybe trying to push the paper to match moments is an endeavor that the paper doesn't have to take, given that at least as a theory piece, helping us understand how the limited commitment would affect, let's say, equity and asset prices is all very, very powerful. Okay, so that's my second point with this, I finish. I think this paper is a step forward in modeling human capital in asset pricing, or at least control in asset pricing. Key ideas, the things to remember is the impossibility to transfer control in production endogenously leads to disasters. That's a key ingredient. The limited commitment makes risky assets riskier, in particular it makes equity riskier. And then I have the big issue, how do we take this model to the data? Maybe you don't have to. But if you're gonna take it to the data, I think there has to be a much more effort on understanding how is it that we're going to match all of these parameters that show up in the model with the world. That's all, thanks.
Thank you very much, Miguel. Let's probably stick to the procedure that we had applied to the earlier paper. So if there are questions from the audience, we might want to take them first. And then, okay, I don't see any hands being raised at this point. Then probably Jessica can start if she wants to reply to Miguel's comments.
Miguel, thank you very much. That was a great discussion. That was super clear and very helpful and perceptive. I really like your point that the essence of the model is it is about a productive asset that cannot be transferred. I mean, that is the essence of the model. So I think that's a great way to think about it, is the bottom line. And we could call it human capital or not, but I mean, what I like about human capital, moving away from the college example, which is sort of illustrative, as you point out, but maybe not good quantitatively, is this is clearly it's a productive asset that can't be transferred. And perhaps that's at the root of other productive assets that can't be transferred, is some kind of match between the talent and the physical asset. So yeah, so I agree with that. I think our thinking on the calibration was really like, is this is this big? Could this be big? Is what was going through my mind. But it's not, as you say, this is going to have to be part, in terms of actually sort of matching the things that we would ideally like to match in asset pricing. It's going to have to be part of some other larger story, because as Miguel points out, we do have a fair bit of volatility. So often if you look at sort of disaster-based models, the actual volatility, the true volatility in consumption or dividends is pretty high, but it's just mismeasured due to a peso problem. And so that's how I would kind of put this paper in that, that's part of what's going on, is it's raising the volatility of fundamentals, but obviously the asset, the premium, it's still a much better fit than the frictionless model. So the goal here was to have a model that has like clearly different conclusions than the frictionless model. And I think our calibration is conservative in that, you can really push this to get like a 4% equity premium if you really want to. But that requires a lot of, yeah, right. But that requires basically all individuals who are talented to be constrained. And it requires parameters such that you essentially don't go into the disaster states endogenously. You basically save their way out of them. So it kind of maximizes the risk sharing problem. Otherwise, like the 2% calibration that you and I showed is sort of a more conservative one, but it's still, as I said, double the case where you just have standard log utility. So yeah, basically I agree. I think the comments are right on. I'd love to think about how really to take this model to the data. Yeah, that's something we're thinking about. I think it would actually be quite useful to ask, like, okay, what are the empirical implications? What are the other implications of this way of thinking about the world?
And I ran out of time, but the wealth distribution is very interesting. And in there we have much less, basically I think that task is much easier than the task of the equity premium.
Yeah, that's perhaps true, but I have a personal interest in the equity premium and what causes it, so I can't quite get away from it myself.
Right. further questions, comments? I don't want to cut anybody off, but I haven't seen any hands being raised. And so I think we can close this first day. And thank you very much to all the presenters, discussants, and the audience. It was very stimulating. And as I had said at the outset, you know, it's bad in a sense that we have this pandemic around us, but it's good on the other hand that this gave us the chance to see some of you for the first time participating in the asset pricing workshop. And I still say here in Frankfurt, although you sit probably all around the globe. And thanks very much for that. I hope I will see most of you back tomorrow. We will start at the same time, which is 3 p.m. at GMT +2, whatever that is, in whatever time zone you sit. Thanks very much.